So we're talking about the bank asset management, and this usually refers to the amount of credits the banks lend out and the securities the bank holds. But most of the time, the securities that the banks hold are in terms of bonds, which are promissory notes. So in a way, they're also part of their credit portfolio. So we're almost literally talking about how banks' assets are the credits that they lend out, all in all. So there usually is a slight discussion about if the banks hold fixed assets, but it's not very common for banks to hold significant amount of fixed assets. They're not in it for asset valuation for fixed assets, but they're in it to collect deposits, lend it out, and then charge fees and have a interest rate differential and have a profit. So with that respect, let's take a look at the two largest banks in the US, JP Morgan Chase and Bank of America. And I'll go through their asset structure and talk about the credits, the securities, and the hard assets. And then I want to talk about how some of the details as to the asset management of commercial banks. We have maturity structures, and we also have gone through the COVID era, where we have witnessed even the treasury bonds costing banks, and therefore, we realized how important it is to even own treasuries in your asset portfolio, which previously we considered to be either risk-free or very low risk. But we have seen in Silicon Valley Bank, for instance, that their bond portfolio collapsed, and some of which was US Treasuries, and it didn't help. So I want to show you how this asset structure can be compromised and can actually cost the bank their license or their existential risk that they're facing. So with JP Morgan Chase, notice that they have almost $3.7 trillion of total assets. And if you look at the breakdown of this, you will see that we have about 0.9 trillion, about $882 billion of cash and cash equivalents, which are some of them are money market investments and cash equivalent. Cash equivalent usually refers to short-term US Treasuries less than 3 months. Now, those again we refer to as risk-free assets. So that's not exactly our concern at this point. We are more concerned about the securities and right here where we see the net loans. So with respect to the cash and cash equivalents and money market investments, notice that this is actually a significant amount of money to have that bears very little interest. So of the $3.7 trillion, almost a $1 trillion is just laying there, earning very little interest, if any. And just last year, because the Fed has been increasing interest rates, they have been earning a little bit. But overall, these cash or short-term items earn almost next to nothing. So a lot of the times, this is safety of liquidity that we discussed in another lecture versus the asset management. So in this case, this is actually opting for safety. Let's check to see if Bank of America has a similar attitude. Notice that in their total assets, they're slightly smaller. It's about $3 trillion. And as such, they have about $500 billion of cash and cash equivalents. So that's pretty sizable amount for both of the banks, where they have this much money just allocated into, very short-term, more liquidity-intended funds. Now, going back to JP Morgan Chase, notice that we have about $1 trillion in securities and investments. And this, again, I want to show you how, even having the US Treasuries can cost you a significant amount of money, which we previously didn't think that this was the case. And notice how we have about, $383 billion of trading securities. And these are considered to be held to maturity, and therefore we don't mark them to the market, which I will talk in a minute. And then we have the short-term investments. These are usually referred to as less than 1 year of US Treasuries. And again, they usually held till the maturity, but we also keep them for our reserves and for our liquidity purposes. And similarly, with respect to the actual loans, we have about $1.1 trillion for JP Morgan Chase. And that loan amount usually what people pay attention to as the quality loan portfolio. However, like I said, after COVID, we've noticed that even having corporate bonds or even US Treasuries, we have witnessed banks to suffer from increasing interest rates, and therefore having an asset portfolio of even investment risk or better rated AAA or AA rated risk can actually become a significant problem. So let's take a look at Bank of America, and we do see a very similar structure for the $3 trillion of total assets. They have approximately $1.1 trillion of securities, very similar to Chase, and another $1 trillion of net loans. So 1/3 of their assets are actually lent out to real loans. Another 1/3 is invested in securities, tradable securities. These are corporate bonds or US Treasuries or international Euro bonds or other international bonds. And then we have another 1/3 that's actually kept for liquidity, prudent assets. And this seems to be the case for both banks. We see again in JP Morgan Chase about 1/3 in securities investments, another 1/3 in loans, and then about another 1/3 in cash and cash equivalents for liquidity purposes. So what problems do we have with respect to having this much, loans and securities? Well, first of all, we have a maturity issue. For the liabilities that we have, these are the deposits. They have very short-term demand, which they can be actually withdrawn at a day's notice. However, our assets are usually longer term. That's probably why the banks keep this much cash at hand, just in case the deposit can be withdrawn. And also, the securities can be traded in the market, although it would actually cost them significant amount of money if they trade it before its maturity, especially nowadays. And then the net loans usually cannot be called that easily. It will be very similar to, think of it like you gave out a mortgage 30 years, and all of a sudden you need the money back, and you pull the homeowner and say, I want the money back. Most homeowners wouldn't know what you're talking about. So that net loan is not really callable. So then the second issue is the default risk that we face as a bank with respect to the money that we are giving out, we're lending out. Well, again, with cash, we don't have any default risk, but with securities and investments, well, it is in our control to take as much default risk as we want. If we go with shorter term US Treasuries, then you're taking a lot less default risk, a lot less interest rate or a market risk, a lot less liquidity risk. However, you're also earning significantly less yield. If you actually take it for a longer term, then even with US Treasuries, you have a slight default risk. Government keeps shutting down. Our politicians keep threatening with not paying the bonds every now and then. So there is a slight risk. In fact, if you consider that the US credit rating is not actually AAA, it's a AA, and therefore we are talking about some slight default risk, especially with longer maturities. And when it comes to corporate bonds, you always have some sort of a default risk. And the longer the maturity, obviously, higher the default risk, higher the market risk, higher the liquidity risk, higher the interest rate risk. And yet, the interest earning or the yield that you earn on a longer term bonds is slightly higher. So, it is a checks and balances. You want to have as much money in longer term and earn as much as possible. On the other hand, you also want to be prudent and have as short of a maturity as possible, as low risk as possible, but then you will earn very little. So it's an optimization. It's not, you can't really minimize this risk. You can't really maximize this risk. It's a maximization. So in the case of Silicon Valley Bank, for instance, I think one of the main issues that they had was that they had significant amount of long-term corporate bonds, especially from tech companies that didn't have significant rating. And therefore, as the interest rates started to go up, their bonds became started losing, credit ratings, and they become riskier and riskier and riskier. And as the bonds become riskier, the yields go up and the prices of bonds go down, which I'm going to show to you in a minute how this is a risk. And with respect to the net loans, same default risk applies. Think of it like for individual loans. If you are, giving a credit to a person with a credit score of say 300 versus 400 versus 500 versus 800, the higher the risk, higher the earnings for the bank. For a person who has a credit rating of 800, I may be able to charge only, say 5%. But if a person has a credit rating of say 300, then I may be able to charge 10 or maybe 15%. So as a bank, the higher the risk I take, higher the return I will have. However, like I said, it's a checks and balances. It's an optimization. A bank may not want to take certain level of risk. They may say, we are not going to take any risks, say below 400 credit score. However, they may actually just go for that range, depending on what type of bank we're talking about. So for larger banks like JP Morgan Chase and Bank of America, you are literally looking at a little bit better asset structure, which means that their securities and investments and their loans will be more on the conservative side. And this may be because of their choice. This may be because of the regulators' pressure. This may be the part of their management structure, but it is ultimately a choice. For smaller local banks, they may not have the luxury to have such a strong, asset structure. It's a luxury to have 1/3 of your assets in cash or cash-like items. And it's a luxury to have short-term US treasuries. It's a luxury to have prime borrowers. This also becomes an issue. If you have a prime borrower, the cost of lending or the process of lending becomes cheaper. Imagine if Apple comes to you and says, we need to borrow, say, $10 billion. It's one borrower, one portfolio, one possibly project, and therefore the cost of reviewing this is what, it's 3 or 4 people. But then again, if you are considering as a bank to lend the same amount of money, say $10 billion to, consumers, $10,000 at a time, who the amount of time it takes, the amount of effort it takes, the number of people it takes, and the process that you have to go through is significantly costlier. So, and in one sense, as a bank, you're trying to optimize, your labor, your time, and you want to diversify, because at the end of the day, if you actually lend $10 billion to a single borrower and that borrower goes under, then you go under with it, or you lose a chunk of your asset structure. And this happened. This happened when GM filed for a bankruptcy about a decade ago, when Chrysler filed a bankruptcy, when the other auto manufacturers filed for bankruptcy. JCPenney did it, Comp USA, Circuit City, and BAC. I mean, we've seen this time and time again when the companies just simply file for bankruptcy protection and go under. And if, as a bank, you lent them money thinking that this is a cheaper way for you and cost-efficient way for you to lend money to a single borrower, well, you're in trouble. And this is exactly what happened to Silicon Valley Bank. They actually had significant chunks of their asset structure lent to certain number of borrowers. And when those borrowers were in the same category, same risk category as, technology, growth companies, new companies, then you are facing a problem as a bank because your entire portfolio consists on your entire asset structure consists on this risk. So, it is the asset structure then refers to the management of your cash, securities, and loans to begin with. And like I say, it's a luxury to have one third of your assets in cash. And when I worked in banks, that would have been it's unreal. But I guess when you are this size of a bank, it's kind of required of you or expected of you as a bank that can have substantial influence on the overall economy. Um, and then we are talking about the maturity structure of the securities and loans as part of your asset management for a commercial bank. You are talking about a default risk and for securities and loans overall. So now let's look at what happens if we were to buy bonds as part of our securities investments, for JP Morgan Chase or Bank of America, where they have over $1 trillion of money invested in this. So first, let's look at what happened to the yields. I'm simply going to look at U.S. Treasury um, yields. And we are looking at, the progress of it, just to see if we were a bank that was incredibly conservative and just whatever we collected, we put it into the U.S. Treasuries, what sort of an impact would it have on our asset structure? And the idea is to show that as a bank, it's never about minimization or a maximization, but it is always about optimization. So you cannot, at the end of the day, you cannot just say, I got $3.7 trillion. Let me put it all on US Treasuries and I'm all set. I don't have to worry about anything. So let's take a look. So let's look at the daily Treasury yield curve and let's look at, say, the beginning of 2022. And let's look at, say, 10 years. So at the beginning of 2022, 10-year yield was 1.66%. And that's brand. And let's take a look at it now. The same 10-year now is about 4.58 right there. So 4.58. And again, all I'm trying to do is if we had a bond portfolio as a bank, as part of our asset management, what sort of loss would we incur? We actually put all our money into a US Treasury 10 years. And if we didn't have to wait, or if we didn't have the luxury to wait until maturity, and if we had to sell some of our treasuries. Look, if you own the treasury and you keep it until the maturity, then the only thing that you're missing out is you basically are missing out the opportunity cost of having earned 4.58%, but you don't really have an actual loss. You literally will have your principal plus the 1.63%. However, if for some reason your deposits are being withdrawn and somehow you need the money and you need to sell those treasuries before the maturity, then you're in trouble. And this example is to show you for $1 trillion of a portfolio, how much it would actually hurt you. So let's say that you have a price of, say, $1,000. That's very simple, and that's your price. And your face is also $1,000, right? So your yield basically will be your face. Let's do this. Your face minus the price divided by the price. Right? So if you buy it at $800, you are expected to earn 25%. And again, I'm not going to go into the time value of money in the 10 years. It's a very simple example. And just to show you that as the yields, as the interest rates increase, the price of bond goes down, and therefore you can incur losses. So in 2022, what I'm going to try to do is I'm going to try to have this yield at 1.63. So if I actually bought everything at $950, $990, $980, $985, yeah, something like that. So if I were to buy these bonds on 2022 January, I would probably buy them at around $985 approximately, right? So, I mean, obviously 987, oops, sorry, 983, so 984, yeah, see, 984. So, and this is 2022. Now, as of today, the yields has gone up to 4.58, which means the very same bond that I bought now is probably about 900 and yeah, oops, something like that, $956. So price now is $956. So the same bond that I actually bought, very much like any other security, I bought this because I have cash, because I have deposits, and I bought them around $984. Now they are $956. So if for some reason my deposits are being withdrawn and I have to dip into my asset structure to get the cash out so that I could meet my obligations, I would have to sell my bonds at 956. And I bought these bonds when they were $984. So let's do a very simple example. So for JP Morgan Chase, you're talking about about 1 trillion dollars, thousand, million, billion, trillion, and that's your trillion dollars. Now, with the $1 trillion, let's see how many bonds would we buy, or we could just do this. The difference would be this divided by this much gives you that many $1,000 bonds. So we would buy this many bonds. Now notice that individual loss on these bonds would simply be 984 minus 956. That's about $28. So if we have this many bonds and $28 loss each, we would have a loss of approximately, what that is? That's about $28 billion. We would just literally lose $28 billion simply because we bought 10-year US Treasuries, which we thought were safe, which they are. I mean, if you wait till the end of that 10 years, it really is. So let's see if we can afford this, right? Let's go to the income statement just to take a look. What does it mean to have that much loss? So for the JP Morgan Chase, their net income is approximately $46 billion. So just the bonds, if they had all their bonds in 10-year treasuries, they would have lost approximately $28 billion. That is actually more than half of their entire net income for the entire year. And if you look at the Bank of America, the same with income statement, and if you look at how much net income that they have, you'll notice that it's exactly $28 billion, which means just this increase in interest rates in 1 year could literally wipe off the entire year's profit for Bank of America. And this is the importance of asset management for banks, for commercial banks. No asset is safe enough to put all your eggs in it. So banks usually choose to diversify as much as they can. They go with credit cards, private individuals, retail, business loans, consumer loans, mortgages. That way, they have a diversified borrower, they have a diversified maturity, and they also go international as much as they can. And they also brings in diversified currency exposure, and that creates them a diversified asset management that has different securities that can be traded even at a cost if need be. So the asset management comes hand in hand with liquidity management. So if you have any questions, please do ask and let me know. And the next video, we're going to be talking about liability management, and then we'll be talking about the capital adequacy or the integrity of the capital structure. And that's about it for today. Thank you.